Hey everyone, welcome back to Upside Down Data. Today I wanted to make a follow-up video about our newsletter that we had released a couple days ago. So this newsletter is available at our site, polaritydigital.io, that we launched in collaboration with Jay over at Daily Crypto Analysis. So first off, if you want to read the newsletter for yourself, it's available here, free to access. You can just go to polaritydigital.io, go to the research section of the site, and you'll see it and you can go ahead and read it for yourself. So Jay had written the first half of this newsletter. He writes about some interesting insights about the total crypto market cap and also about this idea of crypto, so-called decoupling from broader assets. What I wanted to talk a bit more about in this video was the section that I had contributed, which is about kind of market strategy, specifically how we can use the UDPI for different interesting strategies. And most importantly, how we can use the UDPI to help us navigate these rotations in crypto. What I mean by rotation is that dynamic in crypto where some assets tend to run earlier than others. Just in this last rally, if you've been watching the markets, you would have noticed this happen. There's some assets that really pumped hard early, really started running up. Ones like some of the AI tokens, for example, really went kind of parabolic early. Then some other assets followed a little bit later, and some yet even after that. This idea of rotation, that not everything pumps and dumps at once, they go in phases. And the idea is that if you can capitalize on those phases, if you can ride the early movers up, take profits out of them, put them into the assets that haven't moved or haven't moved as much yet, and ride them up, you can compound your profits well above what you would get if you just stuck to only trading one asset. So I want to talk a bit more about this UDPI-based strategy that can help us achieve, help us take advantage of that dynamic that tends to play out in the crypto market during any kind of bullish phase. So I'm going to go ahead and flip over and just show some graphs. I'm just going to zoom in here so that we can get those front and center. So the basic idea of the strategy is based on the UDPI, and it's a weighted DCA strategy, basically. So I'm going to talk about the idea of a weighted DCA strategy first, and then how we can leverage it to do some rotational strategies, and then show you a back test, and all of this is featured in the newsletter if you want to check it out for yourself. So the idea of a weighted DCA strategy is that you're dollar cost averaging. So dollar cost averaging is where you're kind of periodically either buying into or selling out of the market. It could be every day, it could be once a week, etc., whatever. You just say, all right, I'm going to start dollar cost averaging in. And the general idea of dollar cost averaging is instead of trying to time the absolute bottom or the absolute top of the market, you want to kind of average in your buys at generally advantageous positions, generally kind of low points, and then start averaging out of the market at those higher points. So you're not worried about catching the absolute bottom or the absolute top, but just an average good entry point and an average good exit point. That's the idea. So a very basic dollar cost averaging strategy would just be to buy $100 worth of, let's say, Bitcoin every week. And you just do that, and then when you decide it's a good time to start selling, you just sell $100 worth of Bitcoin every week, or however much you decide. A weighted DCA strategy takes it kind of to the next level, because what you're doing is you're changing the amount that you're buying or selling based on some other data. And in this case, it would be the upside downside potential indicator, our risk model here. And so the idea would be that when the UDPI is quite high, when risk is high in the market, that tends to coincide with topping points in the market. So getting out or averaging out of the market at those points is a good idea. Whereas when the UDPI is quite low, that tends to be at these low points, these kind of bottoming out points. We're starting to average into the market through here. It can be advantageous so you can ride it up and average out at those higher prices. So the idea of a weighted DCA strategy is you'd set up some kind of a schedule, and this is just a total example here, but it would be something like this, where you'd say, all right, if the UDPI is sitting below 0 but above -1, so between 0 and -1, I'll buy $25 worth of Bitcoin. If it's between -1 and -2, I'll buy $50, 100, etc. And I do that at some rate. It would either be once a day, once a week, whatever you would decide. And again, the dollar amounts would totally be up to you and how much money you're planning to invest. But this is just an example. And then on the flip side, if the UDPI flips above 0, so now it's getting into the riskier territory, you start selling out. So you might start selling 50 between 0 and 1, 100 between 1 and 2, 200 between 2 and 3, etc., all the way up to the top. Now with this example, you'll notice that it's weighted a bit more heavy to selling more quickly than to buying quickly. The reason for that is that crypto tends to be really explosive and fast moving to the upside, but then kind of slower and more grinding to the downside. So you might want a strategy that kind of takes advantage of that, where you kind of make sure that you get out on the up, because again, it tends to go pretty quick, and then you kind of really want to make sure you're exiting at that highest point. But then as you're going down, you don't want to dump all your money in too early, because price might move even further down and you'd have a better buying opportunity later on. And so you'd want to be kind of more slowly moving into the market, still weighted based on the DCA, on the UDPI, but you'd want to be, spreading it out a little bit more, kind of lower amounts. So that's just one option. You could do whatever you want, obviously. You could set this up any way you want. That's just why I set it up with this particular example. So that's how you could use the UDPI for a weighted DCA strategy. And so this would be an example of just trading one asset, where you'd just be looking at the UDPI level and then just going based on your schedule, buying or selling. Very much a robotic thing. It's not about emotion. It's not about thought. You're literally just looking at the raw output of the model and then doing, what it tells you to do. You're not having to think for yourself, let emotion cloud your judgment, any of that kind of stuff. One of the advantages of a data-driven approach is that it's less susceptible to bias or to fear or greed, leading you to make bad decisions and FOMO in at the top and capitulate at the bottom. So how can this work in a trading strategy? So what we talk about in this newsletter is a back test, where we say that instead of just doing this for one asset, Bitcoin, what if you did it for 4 assets simultaneously? And so you just operated the same strategy, but you're doing it for 4 different assets. So there might be situations where one asset is in the positives on the UDPI, meaning that you're selling it. Then another asset's in the negative, where you'd be buying it. And so what would be happening is that you'd be selling at high UDPI levels, taking those profits into ones that are still relatively low risk, putting the money in so that you can hopefully ride those up and then sell them when they're at higher risk. Take advantage of that rotation. Ride the early movers, sell them as they're getting risky, move into the less risky assets, and then ride them up and sell them when they're risky. That's the general idea. So in this back test, what we did, or basically the way I set it up, was that it started, I believe, right around in here was when this started. Everyone started both a buy and hold strategy, which just bought the 4 assets in equal amounts at that point, that starting point, and then we also have a test one, a UDPI strategy, which would put start with the same amount of money, but then would dynamically be trading it based on the UDPI levels, based on the strategy we've just been talking about. And that ran all the way through to today. So these are the results of what that looks like. So again, the UDPI strategy is trading between 4 different assets. And so I kind of just arbitrarily chose 4. So I chose Bitcoin and Ethereum because they're ones that are probably going to be a part of almost anyone's crypto portfolio. Then I also just kind of randomly chose Atom, Cosmos, and also ADA, Cardano, as being the other ones to have in here. So again, what you'd be doing is you'd just be looking at what their UDPI levels, and I use the same kind of schedule I'm showing here for this here. So again, everyone's starting with $10,000 worth of the asset at this beginning point, so $40,000 total. And then the white line, this UDPI strategy, is dynamically trading based on the risk levels. So it's buying at low risk, selling at high risk between the different assets when they're each hitting those points. Whereas buy and hold just bought that 40,000, 10,000 of each, and is just holding it, it's doing nothing. And what you'll notice very clearly is that at the end point here, we notice that the UDPI strategy is massively outperforming buy and hold. It's about a 3x higher than buy and hold. It outperformed buy and hold by about 3 times, basically. And also, it's up relative to the starting point. So even though the market is considerably down from this starting point in early 2021, the UDPI strategy would actually be in profit right now. I think it's about a 36% profit, which again is not bad. To be able to profit while you're in a test phase that includes the worst bear market that we've seen, in quite a while, ever since 2018. That's a pretty decent performance, I would say. And really, what you notice is that, the ending point is not really that much lower from kind of the all-time high for the UDPI strategy all the way back here at kind of the top of the market back in fall into November of 2021. So that's a pretty good performance. So how does it accomplish this? How is it able to beat the market? Well, we can go ahead and just take a look under the hood to see what it's doing, what relative positions it's taking in the different assets to yield this ultimate result. So this graph here is a lot more complicated, so we'll walk through what it's saying one step at a time. So what we're seeing is the white and the orange lines are the same thing we just saw. So it's the total return of the UDPI strategy in white. The orange line is just the total buy and hold strategy return. But then what we can see is that this green line is the amount of cash that the buy and hold strategy has at any given point in time. So all the other lines here, other than the orange line, have to do what's going on with this strategy here. So the green line is the amount of cash that's on hand. And so what you'll see is that the UDPI strategy in early 21, when a lot of assets were at quite high risk levels. I should also note that we're using the short-term UDPI, which cares about moves of player over days to weeks, a much shorter term in its focus. We're using that one for this backtest so that we can really capitalize on these shorter term movements. You see this really aggressive selling that's happening in early 2021. We're just exiting out of a lot of these positions, especially Ethereum. You'll note that's this pink line, really exiting out of Ethereum as it went and shot up. And then as we go into the summer of 21, we're buying back into the market. We're redeploying those profits that we made back into the market and then riding that up as the market moved up. And you can see we're actually outperforming if we just bought and hold. We're actually getting to a higher point than we would have if we just, would have just bought and hold here and then just held through this time. But then what's really important is what happens here going through the bear market. So you can see we're really aggressively selling out of things as they hit their all-time high. So the purple line here is ADA. It hit its all-time high right around this point here, aggressively selling out of it to capitalize on those profits, just to lock them in, and then just staying out of ADA at that point. Then same thing with Atom. Atom peaked a little bit later than ADA in that cycle, went into its all-time high, aggressively sold it, and then just stayed out of it. So you're locking in those profits, and then you're getting out before this downside here starts. And then with Bitcoin, so that's this light blue line, you can see that we're kind of relatively flat. And what that means is that the UDPI is taking profits, but it's also redeploying into Bitcoin to a degree that the kind of overall value of the Bitcoin holdings of the buy and hold strategy is roughly even. So that's what this is. This is the value of the Bitcoin holdings. And you can see it's actually this whole time relatively even, which means that the UDPI is kind of dynamically trading through it. It's kind of taking advantage of short-term volatility, putting money in at advantageous levels, scaling out at disadvantageous levels on Bitcoin. And then moving forward, as we go into the bear market, we can see we start building an ADA position. We sort of trade in and out of ETH a little bit, but actually it's interesting that the back test, this particular strategy doesn't really see ETH as the most favorable place of being throughout this time, so it doesn't really get into it all that much. And then you can see it starts really aggressively starting a position in Atom going into this big capitulation here, which ended up being a pretty good idea, because what ended up happening with Atom through this period going into June was that it set in a bottom that it showed a lot of relative strength against the rest of the market through this time. And you see that actually this strategy ended with the largest holdings in dollar terms being actually in Atom, and then followed up by Bitcoin, ADA, and then, pretty much no ETH, or whatever has is very little at the end here. But in the end, what that ultimately resulted in was this pretty stellar performance. Now, again, this is just a proof of concept, and these assets were chosen relatively arbitrarily. What you're probably doing if you were actually running a strategy like this is you'd have a wider range of assets that you're watching, and you'd probably dynamically kind of flip through them and which ones you're more interested in based on some other factors, especially in a bear market. If there's an asset that has no fundamental value at all, they have no reason to believe will survive the bear market, some random meme coin, for example, you probably just wouldn't want to have that in this strategy because, it's not going to do you much good. It's not going to work out that well. You'd want to have assets that you have some fundamental belief in that you think will generally trend up with time over time. It's probably the ones you'd want to be including. This is just a proof of concept of the kind of thing that's possible with this. And when you look at the green line, you can really see this kind of profit taking and redeployment. That's this kind of, the squiggles on the line are profit taking, redeployment, etc. And then with this more recent market rally, you can see that the strategy is starting to take profits again and start to hold some cash, exiting out of these assets as they're hitting a higher risk level. So, obviously none of this is financial advice, and there's no guarantee that if you looked at these four assets, over the next, year or two, that it would guarantee the same kind of performance. What it does show is that this is definitely possible. And I think if you kind of use this in conjunction with some other considerations, what assets are probably going to do well in the next cycle, and, kind of being, having some other things that you layer on top of this strategy, it can really help you capitalize on those rotations within the crypto market much better than simply buying and holding. That's one of the powers of having a model like the UDPI, is that it lets you assess relative risk of an asset at one point in time, and then identify when it's getting high risk and you should probably be exiting it, and then maybe getting into another asset to ride that one up. Because that'll happen in a bull market. Bitcoin rallied really early, but if all you did was trade Bitcoin, you would have lost out on massive profits that opened themselves up later on kind of in this bull run here in altcoins. The better strategy in this time would have been to use a dynamic strategy. You would have been selling Bitcoin and then redeploying that in real time into those lower risk altcoins and then ride them up as well. You can just imagine the many multiples you would have made above and beyond just trading Bitcoin itself. So that's something we talk a lot about here on the channel. Something I just wanted to make this video about as well. So to kind of wrap us up, what other thing I want to mention is at polaritydigital.io, obviously not only do we have our newsletter and different articles, but we have the tools that you would need if you wanted to use a strategy like I've been talking about. We have our dashboard that gives you live, real-time information about the current UDPI levels for all the different assets we're currently monitoring. And we have plans to expand this coverage over the coming weeks and months. And so, basically, if you want to do that strategy, all that information's here. You can see the relative UDPI levels, see which ones are particularly overextended at one point in time, which ones are particularly low at any one point in time, et cetera, et cetera, et cetera. So there's a lot of really powerful tools here. And while the website is in its beta phase, this is all totally free to access. It's all right there for you to take a look at. So just something else I wanted to point out. So of course, none of what I've talked about here is financial advice. Make up your own mind about what strategies you think are best, what investments you think are best, what are the best uses or non-uses of data. But I wanted to point this out because I think it's one particularly interesting way that the UDPI can be used that can allow you to take advantage of some of those dynamics we know exist in the crypto market, like the rotation. All right, so again, polaritydigital.io, I'll leave a link in the description. And also go check us out on Twitter, put a lot of updates, better indicators, and more over there.